Welcome everyone to BDO's webinar focused on professional service firms. My name is Anna Gerald and I am the tax partner leading our professional services tax team in the UK. BDO is a global accounting network with over $9 billion in revenues, providing auditing, accounting and taxation services in 162 countries with over 80,000 people. The professional services team have deep expertise advising firms on both UK and global matters. Our speakers today are Mark Walters and Ashley Graham. Mark is a partner in our private client team and is an expert in both US and UK taxation and their interaction. Ashley Graham is a manager in our professional services team and works closely with Mark, advising on those US and UK complexities. You can ask questions during the webinar today. Please use the Q&A feature, which is at the bottom or the top of your screen. We will address as many of the questions as we can at the end of the webinar, or if we haven't got time, afterwards. We're also recording the webinar and we'll email you the slide deck as well as the link to the recording when we're complete. We will finish within the hour. I'm handing over to Mark. Mark, over to you.
Thanks, Anna. So I'm Mark Walters, and I'm going to launch into some discussions really that revolve around Tax Reform Act and where we are post that, with some significant changes for all areas of tax. In fact, it was the biggest changes since 1986. I think the last one of these that we did, we were on the cusp of Donald Trump signing into law tax reform. And I think it's essentially what happened is that between September and December of 2017, they went through various processes of determining what he could get through in legislation. And because of that, the legislation was very rushed at the last minute. So inevitably, as you will all see in the UK, in the revenue practice. Similarly, in the US, we have a series of regulations that help give colour, clarity, and whatever to the legislation. And some of that has taken, well, pretty much 2 years since the bill was signed to get that degree of clarity on. So then in the specifics of the agenda then, I'm going to go on to talk about the tax reform processes that I've just touched on. We're then going to launch into some of the specifics around foreign persons' sale of partnership interests, where there's been some changes. Specifically, there was court cases, and then there was the Tax Reform Act. We then go on to foreign tax credit baskets, yep. Mouthful of that, which has particular permutations for professional service firms. Ashley is then going to talk about and revisit GILTI and what that means and the regulation that's followed on from that. And then we're going to touch on Section 163J, which is how business interests are followed. So what the headlines of what was the US trying to achieve and how that has colour in terms of actually how it's transpired in practice. So headline numbers, corporate tax rates were at 35% in the US. Very substantively, that came down to 21% with no graduated rate. So very significant change in the playing field on corporate rates. Some aspects around creating pseudo-territorial tax system in the US with some transitions to actually get it to a year-by-year consideration of earnings and profits overseas. Ashley will touch on that a bit later. As all tax in different countries come up with, we have simplification, or the word that actually are introducing simplification. What we all know, especially when it comes into cross-border activity, is actually there can be a lot of complication and a lot of things that people haven't thought about in that attempt. Obviously, he wanted to create jobs in the States, and that was the headline from a political point of view, deal with the question of profits shifting out of the US, At an individual level, and this is where it touches into partnerships and professional services alongside the corporate rates, bear in mind that they did reduce the individual tax rates. So they headlined at just under 40% prior to the changes. They came down to 37%. And so that's above $500,000 is when you hit 37% as a single person, $600,000 or thereabout for a joint filer as you do in the US. So the headline rates were down nearly 3%. But the itemized deductions, so the level of deduction you can take against your taxable income in the US, was significantly cut back. So the headlines for people in high tax states like California and New York was you paid a huge amount of tax at the state level, but you got a credit or deduction against your actual taxable income at the adjusted gross income line before you start paying tax. Now they cap that at $10,000, $5,000 on a single basis. So you can imagine for people that are paying very substantive amounts of state tax, that made a huge difference. So the headline may be 37%, but for certain people in high tax states, actually their effective rate of tax actually increased. So that was that. So the end result was, as I said, 1986 was the last big changes around corporates and so on in the US. This, across the board, was the hugest change for 30 years. Where we are. Then finally, just a piece around, as I touched on a minute ago, so the legislation gets put into place. That big rush, he signed it just before the Christmas 2017, and then everyone scratched their heads and thought about what on earth does this mean in 2018 with no regulation that gave clarity around a whole range of issues. And some of those we're going to touch on now because the regulation has come out by and large and gives us a lot more clarity. Some of it's surprises, but overall there's a great deal more clarity around what we have now. So let's get into the specifics of it then. So the IRS always had a view that the code supported the fact that if you owned a partnership interest, business partnership interest in the US, and you realized gains from it, and you're trading in the US naturally, that was US effectively connected income. And to the extent that you realise that on the disposal, you should pay taxes. Prior to the Tax Reform Act, there was a case that went all the way through the US courts called the Grecian magnesite mining case, which was very much a challenge to that, essentially saying, look, you know, we have a partnership interest, foreign source capital gain as far as we're concerned, and arguing that that's the case given that overall it was a foreign business with an interest in a US partnership. They won that case. So that overturned the revenue ruling 9132 that the IRS relied on. So various folks that had paid taxes on the basis they wouldn't fight it suddenly had a basis for doing that. As part of the tax reform, they changed the code. They introduced this new rule that effectively codified the IRS's view that gain or loss from the sale of a partnership interest in the US was effectively connected income, and more than that, you're going to pay tax on the gains that resulted in the US. And more than that, they decided to bring in some withholding tax rules, which were going to challenge businesses when they were seeking a transaction that led to that disposal, to effectively say, we're going to apply some withholding up front because we don't want you running away and not paying our taxes. So that was their point there. And then it'll come back to a question that we might touch on later around, well, actually, maybe a different structure rather than a partnership might give you an option there. So So as I touched on, essentially it's the on a sale, exchange or a disposition of a partnership interest where it's effectively connected income, you're doing business in the US, you're subject to the US rules, and you'll pay the gains on it. There are rules that coordinate with FIRPTA rules, Foreign Investor in Real Estate Property Taxes Act, that stands for, which I'm sure people will come across, where essentially your interest or your investment is in US real estate. So there are some rules that were already in existence to subject an individual business to tax on an investment in real estate. So these rules around the partnership interests have two sets. They point in two directions at once, both at investments generally and at the real estate market. And then there's aspects there that talk about regulation, and the regulation is what we've had since the Act was brought in that deal with the coordination and actually how withholding will work. And obviously, as I said earlier, the Grecian case is pushed into the background, has no relevancy anymore. So moving on, I touched on the rules of withholding, inverted commas, which complement the new rules. So basically, this gives everyone pause to think where they're looking to get into a transaction with the disposal as to, am I going to be subjected to withholding and is there a way around it? And the headline is, as part of these changes, it introduced the requirement to withhold tax on the transferee, so you're putting the onus on the other party, to withhold at 10% on the amount realised from the disposition. So that could be significantly more than any gain that you may have, which for those that come across it is similar to some of the FIRPTA rules around this area. So there are ways of dealing with the process. As a general headline, you need at least 90 days before the transaction to potentially be able to evaluate whether or not you can reduce the levels of withholding, argue against it. And there are a couple of forms, a Form 8804 and a Form 8288. The US loves their form numbers, but that's all around the question of the level of withholding that may apply, or whether or not you've got any get out to the fact that you may need to withhold at all. So moving on to the specifics of that. That level of, the exceptions are where you've got a non-foreign status. Well, that's unlikely. We're talking about foreign businesses having an investment in the US. There's no gain actual realised, so that would be a reasonable basis. And the other is a strange one where it's your allocable share of effectively connected income generated from the US, is less than 25% over the last 3 years. So that may give you a basis on which to step around that withholding level. And then moving on, so we talked about the certification and the level of withholding. There are some rules that sort of interact between FIRPTA, as I mentioned a minute ago, and these new rules, so that if you have real estate involved in part of the transaction, the real estate rules trump, sorry, pun, trump the rules on this. So if there's real estate involved, the withholding under the old FIRPTA rules can still apply as well, which essentially apply a 15% withholding to the level of gain that you have from the real estate, so real property in the US, unless it's less than $1 million when it's 10%. So you then have to go through similar processes in relation to FIRPTA to potentially reduce the levels of withholding. So the headline from all that is you need to think about what the construct of your partnership interest is, and you need to plan well in advance to think about have I got a way to actually reduce the level of withholding that's otherwise going to apply? So that's a pretty significant change there. I think I've covered that. So time. Time is the factor.
Time, yep.
So we're moving on to touch on another subject which will affect many people, and that's a new set of foreign tax credit baskets. So the way the US system works is very much around segregating your foreign taxes into different categories. So over the years, the ones that people may see most often are general limitation baskets and passive baskets. Fairly straightforwardly, general limitation, all your active income, and passive naturally being the stuff that's not active in marketplaces. Two new major baskets were introduced by the tax reform. One was in relation to GILTI, which Ashley's going to come on to talk about in a few minutes. And the other was the foreign branch tax basket. So segregation is the key thought then. And then what on earth is the foreign branch income basket and how does it apply? And the bottom line and probably key issue here is it applies to individuals as much as anything else. So it broadly defines income from a non-US business, including a partnership, operating outside the US, where you're getting business profits that are attributable to what they call a qualified business unit. What on earth is that? So in the tax code, the qualified business unit is what they define as a separate and clearly identifiable unit of a trade or business that maintains books or records, although it then actually, in terms of partnerships, overrides that general rule, and it essentially looks at a foreign branch, even if there are no separate books and records, and says that element of your income is going to be, and the tax that you pay thereon, it will be in this new foreign branch basket. Now, the real worries there was for, if you take a US citizen partner in a non-US professional service firm or operating outside the US and deriving foreign source income, is that historically, remember I mentioned about general limitation baskets, all their foreign tax credits would have accrued in that basket. And suddenly you've introduced a new basket and you've said all the income now is in this basket. So on the basis that oftentimes for different reasons you want to carry forward your foreign tax credits, particularly in the US where oftentimes you're suffering a higher level of tax than you are in the US, this potentially was orphaned from the new foreign branch basket. Happily, they've introduced some regulation which allows you to elect to carry your general limitation taxes over into the other basket. So just flipping over to the next page and trying not to cough. So these regulations only came in November 18, so you can imagine the whole of 18 people were scratching their heads thinking, where on earth is that going to... Sorry, I lost my voice a minute. So how on earth is that going to work? And this ability now allows you to reallocate the credits from the general limitation basket to the foreign branch basket, but you do need to look at the makeup of what your basket was before. So, for example, if someone wasn't a partner in a professional services firm in a prior year and they earned income from a corporate role, those tax credits don't match with the foreign branch basket. So there's some work to do and some thinking to do around the whole election process, but at least you can do it. So, you know, folks need to have taken advice or be taking advice in relation to that. So I've got one more topic to talk about, and that's in relation to what they call a pass-through deduction. So at a corporate level, there are business deductions that businesses can take to effectively reduce their overall rate of tax. Now, if you think what they wanted to do was give partnerships the same ability to benefit from a deduction to reduce their overall headline rate. So if we're thinking about a 37% rate, you effectively could push your rate below 30% if you got this deduction, which was equivalent to 20% of your qualified business income. So well worth having. So what do you need for that? Well, you need a traded business that's got that other word I keep mentioning, effectively connected income in the US. And there are a couple of alternative methods to claiming it, but the headline to have in mind is that 20% of your qualified business income. So that means your business income and gains, but doesn't include your investment income, your employee wages, or amounts that you mark as guaranteed payments to partners. Okay? But there's an alternative, and it should say 20% or greater of the alternative calculation based on 50% of salaries, 25% of salaries plus 2.5% of unadjusted basis. Now, the deduction is limited to specified service, trade, or business.
Yeah. Nearly there, Mark.
And there's a whole range that's listed there around the performance of services and the ones that are excluded from being able to take it. And the way the code is put together is slightly strange because it excludes everyone, but then excludes some of those exclusions. So the bottom line is, and we've crossed through engineering and architecture because they're specifically excluded from the exclusion. So they're carved out essentially. So if you've got an engineering or architectural business, you've got the ability to take this deduction, which is important to you. Sadly, for most others, they don't have that ability to take this deduction. But again, a valuable thing and one of the other key changes. So with that, I'm going to hand over to Ashley to talk about guilty and a couple of other things.
Thanks, Mark. So I think Mark generally touched on at the start about the transition over to a domestic taxation rather than a global worldwide taxation for corporates, and that was one of the main aims of the tax reforms. Before we get into the actual transition and the guilty, one of the other changes which is quite widespread in creating this inclusion for transition tax and also inclusion under the guilty rules was an inadvertent delete of part of the Internal Revenue Code, which effectively made it much more so-called controlled foreign corporations. What that means is, in the US, when you've got a controlled foreign corporation, they are generally, prior to the tax reform, they were taxed in one way. If they had passive style income, so things like interest, dividends and royalties and certain personal service contracts, they would be taxed as if they were essentially passed through to the US investors or the US owners of them businesses. And that was only the case where it was a controlled foreign corporation, so that would be if it's controlled by US people, each owning 10%. So it didn't catch that many businesses. However, the deletion of this part of the code, and it was to do with attribution from foreign parties. So in the example shown where you've got a foreign parent that owns the US and a foreign sub, before the changes, there would be no CFC unless the foreign parent was controlled. But now under the new changes, even if there's no control of the foreign parent, effectively the foreign subsidiary is effectively owned by the US subsidiary because it's under the same foreign control of the foreign parent. So there's quite a lot of structures that we see in the UK where there's a UK company and there may be a US company underneath it, and there may be other European jurisdictions that they have companies in, and that could create a lot of CFC problems and issues just because they deleted the part of the code. So when that was first enacted, there was a lot of worry how that was supposed to be interpreted, whether that was the aim of the deletion. and it wasn't the entire aim of why they deleted it, but they have released some regulations on the 1st of October. So luckily it was just 2 weeks before we had to file all the taxes, and they didn't give any relief to actual inclusion of income, but they give relief to how you can get information. So where you have a minority interest in a company and you're not necessarily going to get all the tax information on a US tax basis, the IRS conceded and said we will accept information to be reported and taxed on the basis of generally accepted accounting principles. So any sort of gap accounts that you could use or any publicly available information, they were willing to accept that you could use that information to calculate the transition tax and the guilty inclusion. So the global intangible low taxed income, before we get onto that, this is the new system whereby CFCs will be taxed where they are controlled by US people. To get to this position, they introduced a transition tax, which is largely been completed over the last 2 filing periods. What the transition tax effectively said was any US corporations or US people that own controlled foreign corporations, they would effectively have a one-off tax charge to so-called repatriate the foreign undistributed retained earnings of the foreign companies to the US and pay a one-off charge. And then any distributions from them companies in the future out of that already taxed income wouldn't suffer additional US tax. And the whole aim of that was to bring more money into the US. That's what Trump was trying to do. He was saying, I want you to invest in the US, Google's, Amazon's of this world, Facebook's, bring your trillions of dollars that are sat offshore to the US and invest in the US. And to some extent, it's worked, but to a large extent that we see, it's not. So that was quite a large change in bringing in all of that undistributed retained earnings. There was a tax break, and that was taxed at up to 15.5%, depending on whether there was liquidity in the company. So there's a big difference, 15.5% compared to either 21 or 35% corporation tax, or the 37% individual tax. So it's quite a big break, but it is a one-off payment for some people, quite a large amount of money that's offshore. So transition tax then basically brings all of the income of CFCs into tax, and then we start afresh under the so-called global intangible low taxed income. And what this effectively is saying, it taxes US people on their share of any profits in excess of 10% of depreciable assets in a company. So the IRS think that, or the US think that, if you're making more than 10% of your assets, then you must be doing something that's in excess of what a business will be doing, which is not always the case, and it's never really the case. So mechanically, it's a tax, a minimum tax on CFCs, and it has a wide sweeping effect on everyone. I think the main disrupting thing that we have seen is that on service providers, particularly where they don't have a lot of depreciable assets, pretty much all of their income is going to be taxed under the guilty regulations. So under the rules, US persons must include gross income of their CFCs as if it was subpart F. So the subpart F is the passive style income, which was under the old rules only how it would be taxed. The subpart F rules are still there, so you've still got the subpart F rules on passive style income, but you've also got the global intangible low tax income rules on everything else. So effectively everything will be caught from a CFC point of view. The way that you look at these is if you have more than one CFC, then you look at them on an aggregate basis, and there is some complications around qualifying assets to get the 10% deduction for qualifying assets, which we'll touch on a bit later on. So, but what you do is you look at all of your, we call it CFC tested income, which is effectively the profits of the business each year under a US basis. Look at all the CFC income, look at all the CFC losses, you aggregate them together, and then the deemed intangible income return is effectively the 10% of depreciable assets. So it actually has nothing to do with intangible income or no intangible assets at all. It's just a way of taxing all of the income that they deem to be in excess of what they think are. So next slide shows a quick diagram of how the tax was imposed on CFCs pre-tax reform and post-tax reform. So as you can see, quite a small portion in most cases for CFCs wasn't taxable because they were generally trading businesses, so the only part of their income would be taxable if it was passive. However, under the new rules, there is quite a lot of the income being taxed under Subpart F and then under Guilty, and then effectively only the 10% of your depreciable assets are not taxed in the US. So the way that you compute the CFC and Guilty income is your net CFC tested income minus 10% of your depreciable assets minus allocable interest expense. And the interest expense is limited under new rules, which we'll go to next, to then come to your Guilty inclusion amount. And there's certain items that are excluded from CFC tested income. So anything that is included under Subpart F originally, so there's no double taxation of that. Anything that's effectively connected income is already taxed in the US regardless, so they don't bring that into it. And certain dividends to and from related parties are exclusions for that. One of the major concerns that we had when the rules originally came out, there was an exclusion for C corporations, that's a US company. So US companies that own CFCs, they were afforded a 50% deduction of their Guilty inclusion amount, plus a gross up for deemed foreign taxes. So effectively they would get a deduction against the inclusion, their Guilty inclusion of 50%. So you'd only bring in 50% of the income from the CFC. So it reduced, for a corporation, it reduced their tax rate from 21% to 10.5%. And in addition, they were able to utilise 80% of the foreign tax credits that were paid by the CFC itself. So they would, in a lot of cases, wouldn't have a lot of US tax to pay, if any. However, this wasn't afforded to US individuals. So if you're a US individual that's in a partnership or in a company that has CFCs, that has this issue, you weren't afforded this benefit. So you will be taxed at the individual income tax rate, the gradual tax rates up to 37% with no deduction and no utilisation of foreign tax credits. So I think it took maybe 7 or 8 months over the summer, June, July time, they released some regulations around how they would help mitigate that, and there was a lot of thought around existing rules that were never used, that have been in existence for 30 or 40 years, that were never used, but now are becoming the norm for people to use. And that's the Section 962 election. And the Section 962 election is effectively a US individual electing on their personal tax return to be taxed as if they were a corporate on their CFC income. So you basically put yourself in the shoes as if you were a corporate, and you tax yourself as if you were that way. But there was nothing in the law that said anything about getting a deduction for an individual. So again, it was a bit of a grey area. So there was a lot of representation to the IRS, and they eventually came out with regulations that said, if you met this election, you are able to take the 50% deduction and also utilise the foreign tax credits as if you were a corporate. So it's good also for the deduction, but also it reduces the rate from the graduate 37% rate to the 21% rate. So in a lot of cases that we've seen, particularly UK businesses, for this year and next year, where the UK tax rate, corporation tax rate is 19%, there'll be no significant US tax to pay. There shouldn't be. When the UK corporation tax rate reduces, as expected, then they may not be able to utilise the foreign tax credits because of there's a minimum amount of foreign tax the corporation has to pay to be able to utilise the foreign taxes, and that is 90% of the US corporate rate, which is around 17.9%. So when the corporate rate in the UK goes down to below that threshold, no one will be able to use the foreign tax credits for this Guilty inclusion amount. So, like I said, the election is quite new. The election is quite new and has been around for years. In my experience and with the conversations I've had with people, I've only come across one person that's ever done it, and he's done it once. And that's because the corporate rate was 35% compared to the personal rate was 39.6%, so there was no advantage to doing it. But now it is being really looked at, and there's detailed tax calculations being modelled to see whether it is a better position. So it's definitely worth something to look at and thinking about. So think on this example here, kind of runs through how the CFC income will be taxed. So if you had income in the CFC, you have income which is then reduced by the 10% of your assets with a tax credit and a deduction to bring in your guilty inclusion amount, and then tax suffered on that. So ultimately, if income from a CFC which previously wouldn't be taxed, as the example shows here, there would be additional US tax to pay, which is not ideal from a business point of view either, because how do they physically do that income to then pay the tax? So it becomes quite circular that the business needs to distribute the income. If the shareholder doesn't have enough cash to pay the tax, they need to think about how the business is going to be able to distribute, or some mechanism for them to giving money to the shareholders for them to then pay the tax. So it becomes quite circular. And then you can run into issues where you've got tested income of CFCs and tested losses of CFCs. So under the rules where you're looking at tested income and tested losses, you add them together effectively. All of your tested income and all of your tested losses of a CFC are added together. But then when you are looking at the 10% deduction for your depreciable assets, you only bring into account depreciable assets of CFCs that have tested income. So if you have a company that has tested income with no depreciable assets, and you have a company that has all the depreciable assets and a tested loss, effectively the entire net income is going to be taxed under GILTI, even though across the whole group you've got quite a lot of assets. And the next scenario kind of looks at that and then adds in another layer of, if you made certain elections in the US to have them treated as so-called disregarded entities or pass-through entities, then effectively everything would flow into just one CFC or one company. So it's definitely worth looking at and thinking about. If you have these problems where you've got CFC income, CFC losses, and your assets don't match that income and losses, there is potential benefits to making certain elections in the US, so then you can have one large CFC to then utilise all of the depreciable assets across the group, and it might get you into a better position. I think we've covered the 962, I think that might be twice. So that's everything on the GILTI income. I think the next short piece is on an additional deduction for corporates. So you can see there's quite a common theme here. A lot of these reforms are driven towards giving corporates a benefit, whereas the individuals weren't really thought of and how that would interact with it. So this deduction, the foreign derived intangible income deduction, is effectively looks at the US corporate's foreign derived income, and to the extent it has foreign derived income, you can get a deduction of up to 37.5% against that foreign income. And the foreign derived income is anything that is a sale or lease or exchange, or services in this case, any services which an employee or a partner, an employee of a US company provides to a non-US customer would be considered foreign derived income. So you'd have to track the income on the US base and also what is foreign to then determine your foreign derived intangible income. And again, this gives you another deduction for corporates to further reduce their tax. And that this is more akin to just on the corporate itself opposed to any CFC. So this is only relevant for US corporates if businesses are looking to set up US corporates as an additional incentive there. So the application of the limitation on business interest, this is quite a large change which affected quite every business operation. Under the old rules, there was so-called earnings stripping rules whereby it would only impact corporate US corporates that had related party loans, and there would be certain rules where it would be limited depending on the makeup of the US borrowers, debt equity ratio, their other borrowings, whether the foreign party suffered any US tax. However, they changed that, they changed everything, and they brought in a new law under section 163J and said basically any business interest expense incurred by a US person is potentially subject to a reduction in the amount of interest that they can deduct for US tax purposes. And it was irrelevant of whether it was related interest, related party interest, unrelated party interest, whether it was foreign or domestic. So quite a shift away from the old rules. There's no safe harbour of the 1.5% or 1% debt to equity ratio, and there's no requirement for US tax to be suffered by the person that's borrowing the money. Effectively what the rule does, it says any business interest cannot exceed the sum of your business interest income or 30% of your adjusted taxable income. Adjusted taxable income being EBITDA until 2021, and then after 2021 it's EBIT, earnings before interest and tax, so they get rid of the depreciation and amortisation. So it potentially gets a little bit better. And then in addition to that, they can add in also the floor plan financing, but that's only really relevant to car dealers. So in our case, we're just looking at business interest income and 30% of EBIT, EBITDA, and then EBIT in 3 days. And the business interest income is anything that's business interest that's in relation to a trade or business, so a lot of cases we won't see business interest income, probably because it's not part of the businesses that we see. Their business wouldn't be dealing in loans. So we're mainly, what we see is the 30% of EBITDA limitation. The good thing about it, if there is a good thing, is that the amount that's non-deductible in the current year can be carried forward, and it can be carried forward forever. There's no expiration currently on that. So in years in the future that you might reduce your loans and your borrowing, you might have some interest expense at least to use in the future. There are certain exemptions that can be applied, so under a small business exemption, so if you are a recipient of less than $25 million per year of gross revenue, you can apply to be exempt, whereby this rule doesn't apply to you. However, there are attribution rules similar to what we talked about, the downward attribution and all of that. There's attribution rules between different businesses and different ownerships where it gets a little bit twisted and a little bit mangled between what actually is included in it. So it does get quite tricky, and in my experience, a lot of people have not tried to use the small business exemption, have gone with caution really. There's also a real estate exemption for real estate professionals, which we've got a couple of slides on a bit later on. So it overlaps a little bit with the guilty inclusion, so there might be potential deductions for interest when we're calculating the guilty inclusion, but there are alternatives. So there are alternative structures that people are looking at and alternative ways of getting finance, so then there is no interest, or there is an effective deduction for the same amount of the interest. Some of the crossover with prior rules and still existing rules, we still need to comply with transfer pricing. There's no grandfathering of existing debt, so all existing debt that was previously under the old rules is caught, So straight away, everyone is caught, and you need to look at them as of the day that this came into effect. So 1st of January 2018, it affects everyone. Some planning ideas. So some preferred stock, preferred partnership interests. Having a look at the global worldwide tax liability, possibly shifting some debt and refinancing, so it's not in the US, so it might be in a jurisdiction where it's more beneficial. Issuing debt through a real estate company, which we'll come to a little bit more on the next slide or the slide after. So in the next slide, there's one of the considerations is to have preferred partnership interests, and what this effectively is where you have a third party who wants to lend you money, if you could go into a partnership with them rather than having a loan, you can have a so-called guaranteed payment for capital contributed, which is not technical interest. It's not interest. It's a specific code within the US rules where payments that are for capital for a partner, for partner's capital, is not interest. It's a guaranteed payment. And that is an allowable deduction in the US. So there is an option to, rather than receiving a loan with a coupon rate, you could go into partnership with the lender and have a similar coupon rate, but have it as a guaranteed payment. Obviously, there are implications to that. There are other factors to consider other than just tax. Effectively, how it would work is you would contribute your capital, and then when you calculate the profits of the partnership, or the LLC in this case, you would calculate the profits and deduct the interest or the guaranteed payment amount from the annual profits, and that specific income will be allocated to the partner, which is lending the money, which has to have the guaranteed payment. So everything it still work the same. There'd be deduction at the partnership level, which everyone would benefit from, and then there would also be the income inclusion at the lender, at the borrower, from the lender. So some other issues to think about when you think about the preferred partnership interest are there's quite a lot of anti-avoidance. There's some general anti-avoidance around partnerships and the business purpose of them, whether they're truly going to partnership together or not. So there's things to consider there. So it might not be beneficial if you're just getting a genuine loan, but if it is business partners that are lending money, then it would be beneficial to look into this more. I think the main exemption that I've seen quite a lot of this is the real property business exemption. And effectively, where you're a real property business, you can elect out of being subject to these limitations. So, because real property is usually quite highly leveraged and there's quite a lot of debt in the structures, they've allowed an election to not apply the interest deductibility, so then you can utilise that. You could also consider, from a corporate perspective, you could also consider if you've got half of your business is renting out property and but the majority of your business is doing something else, then you could think about splitting them two businesses into two distinct parts. So then you could effectively have one of them elect to be the real estate holding entity. So then you could use a full deduction of the loan against the property, and then the other business would discontinue without the loan because it wouldn't have the loan. It's kind of illustrated a little bit on the next slide. So if you had a US parent, for example, that has US real property, but its main business is not real estate, you could segregate them. So then you'd look at the entity which it owns, and the entity which it owns would be a separate standalone entity which operates a real estate business. So you could make an election for that separate entity to not be subject to the interest limitations. So I think the key takeaways from all of this is that the tax reform rules have made it a lot more broad and made fundamental changes to the US tax system, in particular the international tax system. A lot of people are considering how that impacts them, looking at different modellings for how a lot of the rules work for them and how that's going to impact their business. The GILTI rules and also the interest deductibility rules apply to everyone. And if anyone's going into any current restructuring or M&A planning, then we need to consider all of the implications.
Right, well, wonderful. Thank you very much, both of you. Plenty to take in there. A couple of questions, but just a general observation in terms of the changes that are out there and the implications for professional service firms that have global presence. There's always demands on firms' time in terms of considering the local implications of doing something. But the US obviously is just an area that a lot more focus needs to be put on for existing businesses as well as new ones that are being set up, which sort of really leads me into our first question, which is around structure. Say you've got a UK business that is looking to go inbound into the US. What's your current thinking of using a corporate structure versus partnership structure, given all of the comments that you've made around the various reliefs that are available for one structure rather than the other?
Yeah, well, I mean, absolutely. It's turned everything around, really, because historically, with the perception of very high corporate rates of 35%, and the ability, perhaps if you're a partnership already, to think in terms of, well, that's sensible for my structure and how I do things. Now with a corporate rate down at 21%, that changes the playing field hugely. And when you build into that some of the other things around, like the Grecian case and the overturn of that, and the whole question about the ability to take deductibility expenses, then as a partnership, you can be in a disadvantaged situation, and corporate can actually really make a significant difference. So historically, you might have, as a partnership outside the US, thought in terms of LLC, and then the challenges we had in the UK market of Anson and all those things, or partnership in some other form, but wanted to avoid the corporate world simply because of the rates. Now we have a very different perspective on inbound thinking and going into the US market. Sure.
Anything to add to that?
Yeah, I think that's right. We would typically avoid corporates because of the high tax rate, I think, but now it is being thought of. I think it's being thought of more because of the lower tax rates, but also I think it helps segregate the business a little bit in terms of the deductions that they receive, particularly around the GILTI inclusion as well. I think that can sometimes create some problems because it does create some CFC issues. But again, that can be managed by using a corporate and not having to think about having to look at the different exemptions that you have under the elections of the 962.
Yeah. So it's not straightforward. It's not one of these ones that you can say, oh, given the rules, okay, so the new structure that everybody should use is X. It comes down to what we generally hear and advise on, which is, well, what are you trying to achieve? What are your objectives? What is extracting, not extracting? What do you want to do in terms of funding? And really looking through all of what we've been talking about here and into the future.
So certainly new businesses you may think differently, and then for existing structures, scratch your head again and think, actually, do I need to model something differently depending on how it's all put together in the US at the moment?
Yeah. Okay. Now you did talk, and it is a bit of a tongue tire, but the foreign branch. Foreign tax credits.
Yeah.
But what does this really mean in practice when you've got a US partner who, say, has an interest in, say, a UK LLP?
Yeah.
What's the practical implications of all the changes that you've talked through today?
Well, I mean, it's absolutely key that they take some advice around what their foreign tax credits look like, particularly in the context of that carryover. And as I said earlier, if you've got partners that have worked in different countries and suffered different tax rates, then it's not uncommon for them to get to a situation where they need to use that foreign tax credit carryover from an earlier year. And what you don't want is, as I described, the situation where you've got in different baskets and you can't utilise it. So the elections are key on a year-by-year basis to give the individual the ability to effectively elect to transition those general limitation foreign taxes into the foreign branch basket. And that isn't always straightforward because inevitably people's careers, they've moved in different places.
Yeah.
So that basket that they've accumulated, and in some cases that's really very large numbers over a number of years, could be made up of all sorts of things, some of which can be allowable as a credit to this foreign basket and some aren't. So you have to scratch the surface and really do the evaluation on that.
And so in terms of record keeping information,
Indeed.
actually digging into the detail and giving it enough time to do the planning, it's not one of these things that you want to be doing just before you're trying to put your case together for your filing. Okay.
Yeah, I think getting into the detail of how the makeup of the carry forward from 2017, how the makeup of them foreign tax credits are, which can be made up of a lot of years, 10 years we have to go back.
Yeah.
That's been a difficult time.
Okay, we're just running out of time, so I think we'll leave it there with the questions, but thank you both very much for your time. I appreciate both of you are suffering slightly from cold, so pleased that there was no big coughing fits, but thank you both. And in terms of for our listeners, we will be sending a recording and the slides shortly after today. So thank you all. Thank you for listening.